All right, welcome back. So, chapter 15, job order costing. In this course, we're going to look at generally two types of job costing. One is job order costing, and the other one is process order um, costing or process operations. All right. Um, what is the difference? So, process operations, or what I call process order costing, it's also called process manufacturing or process production, lots of different names. It's basically the mass production of large quantities of similar products where you can't differentiate the product necessarily. So think of making milk, for example. When you're making milk or processing milk, you just have a big set of liquid that's called milk. You can't really pin a certain amount of labor or a certain amount of materials to a unit of milk. All right. And we're going to talk more about process costing in chapter 16. Job order costing, on the other hand, has to do with specific jobs. So you can actually see a unit of the product or of the job that's being produced. Think again when we talked about chapter 14, we talked about producing bikes. Bikes are separate units that you can actually count, right? Think of cars. Cars are separate units. We can get even as elaborate and complex as houses. Houses are separate units. So you can apply cost to each unit within that job. And that's what job order costing is about. Being able to trace all the inputs, so your material, your labor, and your overhead costs to a specific job or to a specific product. So that's what you're going to be looking at in chapter 15. As we mentioned before, the main inputs are um, your materials, because you need those to build the units of whatever you're building. You're going to need labor, so you're going to have direct materials, direct labor, and then you're going to have your overhead costs. So let's talk about each of those. Um, Again, you're going to need materials, so you're going to go out and you're going to buy materials, and we call them raw materials inventory. Okay. And if you remember from when you did accounting 101, when you bought inventory, so you're purchasing the inventory to either resell or reuse in production. But what you would do is you would debit your inventory account for the amount of inventory items that you've purchased, and you would credit either your cash account or a payable account. The cash account is if you paid for it in cash or a credit card, or some other liquid asset that's similar to cash. Um, and I say that only because there's crypto and all these other types of currencies that can be used. But if you owe the person, you did not give them anything in settlement yet of purchasing that inventory, you owe them, you would credit a payable account, all right, such as an account payable. Same thing in managerial accounting. When you go to buy the raw materials that you're going to make your bike, so you need to buy the aluminum or aluminium, however you pronounce it, that's going to be the frame of the bike. You're going to purchase the bell for the bike. You're going to purchase the tires for the bike. You're going to purchase paint for the bike. All that stuff is considered raw material. So you're going to go and buy that from a producer or manufacturer. And when you buy that stuff, you're going to debit your raw materials inventory account, and you're going to credit either your um, cash account or a payables account. All right. Now, as you start to use those products in the building of your units, you'll need to make accounting entries as well. So someone's going to submit a requisition and say, I need two tires and I need how much ever aluminum or aluminum for the bike. They're going to hand you a requisition telling you that they need these raw materials. So now what you're going to do is you move the amount of raw materials that are needed to produce that item from your raw materials inventory account, and you put it into your work in process inventory account. And so that's how you record entries for your materials. You also have to record entries for your labor. So as your workers are working on the bikes and they're submitting their time cards, you will debit your work in process inventory as well, and you would credit your salaries payable account. All right. Later on, this is accounting, this is financial accounting, this is not necessarily managerial accounting, but later on, when you pay them, you will then debit your salaries payable account and you would credit cash. We're not dealing with that in this course, but I just wanted to point out that entry. But for purposes of this course, you will debit your work in process inventory account for the amount of the cost of the labor, and you will credit your salaries payable account. And that's how you would record the labor costs for the items that you're making. The last thing that I want to talk about is your overhead costs. So again, the overhead costs are the costs that they cannot necessarily be attributed to every specific item. But you probably need to find a way to do it, right? Because you want to know how much of that factory that you're building in should I be charging back to that unit that I'm producing. So there's a 4-step process for your overhead costs. You start with the predetermined overhead rate. You apply the estimated overhead to the jobs. You record the actual overhead that occurred, and then you close the overhead. So number one, you set the predetermined overhead rate. Applying overhead to jobs requires a predetermined overhead rate, which you'll see in your textbook, also called a predetermined overhead allocation or application rate. All right. And this in turn requires an estimate of total overhead cost and an estimated activity base before the start of the period. So before the start of the period, you would say, this is how much direct labor I think will be needed to produce the items that we want to produce this year to sell to customers. And these are the total overhead costs that are anticipated to occur. And then you would divide those two numbers. So you would divide your total overhead costs by your direct labor costs, and that gives you a rate. And then you use that rate in step 2 to apply overhead to jobs. All right. So if you look at the example in the book says, let's compute Road Warrior's predetermined overhead rate. At the start of the year, Road Warrior's estimated total direct labor costs were $125,000 and the total overhead costs were $200,000. And so you would divide your 200,000 total overhead costs by your estimated activity base, which is direct labor hours, 125,000, and you would get 1.6. All right. So then you apply that 1.6 to the jobs. So for every job that is occurring, you would take your predetermined overhead rate and multiply it by your activity based used. And that will give you what your applied overhead should be. So let's say that for bicycle B15, and I'm following the example in the textbook, bicycle B15, your direct labor costs, which is your activity base, were $1,000 for that bicycle. In order to apply the estimated overhead, you'd multiply that 1,000 by the rate we just calculated, which is 1.6, and that gives us 1,600. And what we would do is we would debit what's called a work in process inventory account, for that $1,600, and we would credit factory overhead for that $1,600. Similarly, let's say we had bicycle B16, and let's say it's a highly customized bicycle, so it took more labor. So the labor on that one was $2,000. To apply the estimated overhead, we would multiply that 2,000 by the 1.6 predetermined overhead base rate that we calculated. That gives us $3,200. And then we would post that entry to our accounting system by making a debit to our work in process inventory for $3,200 and making a credit to factory overhead for $3,200. All right. And that is how we would apply the overhead in step 2. In step 3 now, we would record our actual overhead rate. All right. So whatever the actual costs are is what you would record. Okay. So as the book says, we record indirect materials used, for example. So during March, Road Warriors incurred $550 of actual indirect materials costs. So what we would do is we would debit our factory overhead for that $550 cost, and we would credit our raw materials inventory for $550. It also says that during March, Road Warriors incurred $1,100 of actual indirect labor costs. So then we would debit our factory overhead for $1,100, and we would credit our factory wages payable or salaries payable. It's usually wages for factory workers for $1,100. All right. The last part is to determine if any of the cost was over or under applied. Okay. And if you read through the chapter, you'll see how it describes it. All right. So if we applied in our factory overhead account, we have our actual amounts that we applied as debits. And then we have our actual amount that we credited at the beginning. And the difference between those would give us our overhead that was either over applied or under applied. All right. So if our actual is greater than our applied, which means we incurred more costs than we actually applied, because remember, what we applied was an estimate. All right. What we applied was just an estimate. We're actually going to record what we used, right? If the actual was greater than what we applied, that means that we under applied our overhead. All right. And so we would need to make a journal entry debiting the amount of what we under applied to cost of goods sold and crediting the rest to factory overhead. All right. Now, if the actual that we incurred was less than what we applied, that's going to be a situation of having over applied. All right. So now we need to debit our factory overhead and credit our cost of goods sold. Why are we doing that? Again, at the beginning, we did an estimate. It was just simply an estimate, right? As we move through the year, we got our actuals. We got our actual numbers. So if my actuals were more than what I actually applied, the amount that's going into the cost of my product was less than it should be. And the cost of the product goes into your cost of goods sold. So that's why we need to debit our cost of goods sold to increase it, to bring it up to what we actually incurred. And remember, when we did the estimate, we put that amount into factory overhead as a credit. But that credit is going to be too low because we spent more than what we put on the credit side of factory overhead. So the entry to increase that factory overhead amount would be a credit, right? Because initially we credited it for, let's say, $1,000, but we actually incurred 1,500, so we now need to credit it for an additional 500. And again, the rest of that goes into cost of goods sold as a debit to show that the cost of the products were actually more. On the flip side, for over applied, if we put too much in our factory overhead, it means we said that the cost of our goods are too much, so now we need to reduce it. And the way we would reduce it is by taking it out of our cost of goods sold. And to reduce our cost of goods sold, we would make a credit to that account. And remember, again, at the beginning, when we made the entry for our estimated factory overhead, we put a credit to factory overhead. But now we're saying that credit amount is too much. So if I have too much on my credit side, what do I need to do? I need to reduce it by making a debit. So that's why if it's over applied, we would debit factory overhead for the amount of which it's over applied and credit our cost of goods sold. And those are the main points that I want you to take away for this chapter. As always, if you have any questions or if any of these concepts are difficult for you, please reach out. Happy to assist further. Thanks.